If you take a nominal amount of money, say $5 a day saved from skipping a coffee, and put it to work at an average 10% return, in 45 years, you'd have nearly $1.6 million. But the moment you decide to actually invest that $5, you hit a wall. Social media is obsessed with finding the next explosive tech stock, making the entire process feel like walking into a casino and trying to predict the future. The red line represents the casino mindset. Chasing individual stocks leads to wild spikes and deep crashes. The blue line represents a broad index fund, trending steadily upward over time. We're looking at the structural mechanics of holding individual stocks versus owning the entire market. We are weighing the high probability of reaching a long-term goal against the extreme low probability magnitude of hitting one lucky winner. Where you decide to deploy your capital entirely dictates the level of risk you take on and the emotional toll you'll pay along the way. When you buy shares in a single company like Amazon, Tesla, or Meta, your money is tied directly to one CEO, one supply chain, and one quarterly earnings report. You get the massive market-beating upside potential if they succeed. But if that specific company misses the mark or faces a scandal, your portfolio sinks right along with it. Looking at this comparison matrix, an index fund spreads your $5 across the top publicly traded companies. By holding hundreds of companies, you dilute the damage. If one fails, the others hold the line. The trade-off is losing the chance to catch a unicorn stock. You actively trade the thrill of a massive short-term gain for the high-probability mathematical survival rate that comes with diversification. But picking the right asset is only half the equation. The specific account you put that asset inside determines how much of your profit you actually get to keep. In a general investing account, a massive percentage of your profits is sliced away by dividend and capital gains taxes. But account B, a tax-advantaged account like a Roth IRA, acts as a legal shield, entirely blocking those tax drains so profits remain whole. The catch is access. Tax-advantaged accounts usually cap your annual contributions, like the $7,500 limit on a Roth IRA, while general accounts offer infinite flexibility. Ultimately, shielding your money from taxes through structural system design will do more for your long-term wealth than perfectly timing a stock purchase. Investors often find the emotional toll of a market dip far more difficult to manage than the actual math of their portfolio. When an investor sees a negative return in their first few months, panic sets in, and they abandon their strategy to pull their money out. To counter this, dollar-cost averaging means investing the exact same amount on a strict schedule, ignoring the market. When prices crash, your $5 automatically buys more shares at a discount. When the market peaks, it buys fewer shares, naturally balancing your average cost. Automating this schedule completely removes the pressure of trying to time the market. It turns terrifying market crashes into passive buying opportunities. Inside that automated system, you have one final choice: how to handle the dividends those companies pay you just for holding their stock. You can choose a distribution model where those dividends are paid out as liquid cash for you to spend immediately, or in the accumulation model, those cash dividends are automatically used to buy fractional shares of the fund itself. These newly bought shares generate their own dividends, creating a compounding loop that accelerates entirely on its own. By sacrificing a tiny bit of liquid cash today, you automatically supercharge your exponential growth for the future. So, which strategy actually matches your life? That depends on your personal psychology, your free time, and your tolerance for risk. This decision tree maps the performance-first stock picker. If you have hours to research earnings reports and you can stomach watching your portfolio drop 20% without panic selling, active stock picking is your path. Just know that it is an intense, high-maintenance job that will frequently test your emotional limits. But if you are short on time or investing on a strict budget, the alternative path leads you here: an automated index fund shielded inside a tax-advantaged account. Building a system that keeps you in the market for decades is more valuable than trying to be the smartest analyst in the room. A broad index fund fueled by automated daily contributions, locked inside a tax-advantaged account. That is the ultimate low-friction framework. When you apply that exact framework, a simple $5 daily habit bypasses human emotion and guarantees mathematical progress. Choosing a reliable system and letting time do the heavy lifting removes the impossible burden of predicting the future.